morning, everybody. Welcome to the latest in the series of hotel webinars hosted by AlixPartners, HVS, Bird & Bird, and EP Business and Hospitality. We're just gathering at the moment and seeing numbers creep up on attendees, but appreciate everyone taking the time out of their day to join us for this. So I'm Graham Smith from AlixPartners, and I specialise in advising on corporate finance and restructuring transactions in the hotel and hospitality sector. So the webinar today is going to focus on the rapidly developing branded residences market, and in particular how this interacts with the hotel world. And I guess what we've seen, why we thought this was an interesting topic to cover today, is that hotel developments are increasingly featuring a residential component in order to enhance returns. We've seen many of the leading hotel brands developing successful residential extensions to the hotel operations, and sometimes wholly separate from an adjacent hotel. We've also seen non-hotel brands getting in on the act, whether it be fashion houses, car makers, and even sports teams becoming increasingly active. Now, aligning residences with a hotel brand can enable a developer to sell apartments at a premium price, and it's not only at the luxury end of the scale where the relationship can drive higher returns. So to help cover all this today, we're going to feature a presentation by Chris Graham, who's founder and managing director of Graham Associates. They're a leading specialist in international luxury residential real estate. Chris is going to set the scene and help develop our understanding of the sector. Then we're going to pass to Simon Price, a partner at Bird & Bird, who'll highlight some of the key legal aspects you need to take into account. Then we're very fortunate to have a panel session with some fantastic panel members, and also hosted by Karen Freeb, head of hotels at Bird & Bird. So we've got Ina Plinian from Cedar Capital Partners, James Price from Four Seasons. We've got JD Menezes from Marriott International, Deepesh Thakra from Oak North, and Aoife Roche from STR. So through the webinar, do feel free to use the Q&A functionality to pose questions, and we'll try to address these through the event. Before we get into the content itself, we have some polling questions that we'd like to put to you, just to help set the scene. So if you can all be ready to provide your responses to these. Question one is, have you been directly involved with a branded residence development or completed a project already? So if you can select yes or no for that. The second question, do you anticipate being involved in branded residence developments or completed projects in the next 18 months? Third question, how do you think branded residences penetration in the market will change over the next 3 years? So we need to select from multiple choices on that. If we can just kind of scroll down on the question. So do we think that will materially increase, slightly increase, stay about the same, or reduce? The fourth question, what are the most important elements in making a branded residence a success? And you can choose 3 from the list below. So location, brand, broader brand benefits and loyalty, using an experienced operating partner. Is it the design of the property itself, possibly the on-site facilities, or being more specific, the on-site F&B and retail? And then the final question, how do you think the presence of branded residences in a hotel development impacts overall valuation? Is it positive? Is it neutral, or is it a negative? So if you can all add your answers to those questions, that'd be great. We can then spin through the answers. So on the first one, we have a bit of a mixed picture in terms of people who have been involved. So I think we have some experience here, 61% having done that, but then others who are sort of interested to know more after having not had direct experience. Interestingly, as we then look at whether people expect to be involved in a project involving branded residences, very much the majority of people on the call expecting that, which is great. So almost three-quarters of people. Also, everybody voting there to suggest that there's definitely going to be an increase in branded residences in terms of penetration in the hotel market. Almost, well, 97% there of people expecting that. In terms of what's most important, looking at the data there, we can see, well, location, doesn't matter whether it's branded residences or hotels, it's still all about the location, it would seem, the brand you choose, and then also the third most important thing there, the facilities that are then provided on site for the residents. And then finally, I think very much a positive view of how branded residences impact valuation. So that's great. So thank you very much. Some interesting perspectives there, and I'm sure we'll pick up on those as we go through the webinar. So that leaves me now to hand over to Chris. So Chris, if you can come on camera, it'd be great for you to now set the scene for everybody as to what's happening.
Yeah, good morning. Thank you, Graham. Sorry to crash your party a little bit early, a little thing trigger happy. So just to take you through a sort of a scene setting background to the industry. Firstly, just a little bit about me, because some of you may be wondering who I am and why I'm talking to you. I fell into real estate about 25 years ago when I was recruited as Group Marketing Director at Hamptons International. And subsequently, when I left, I set up my consultancy, which has been specializing in international luxury and branded residences ever since. We've been working with quite a wide number. A snapshot of some of the clients that we've worked with and some of the brands is listed at the bottom. But more particularly, it's because I authored the first ever report on branded residences, which was only about 10 years ago, when I found there was absolutely nothing on the market whatsoever. And I've got two reports. One is the first one, which is now in its sixth edition. And the second one, which is a relatively new one, is called a compendium, and that is a listing of nearly all of the brands that are active in the space. Both of these are available free on my website. If you would like to get copies, I'll be more than happy to share them with you. Now, to start with a little bit of history here. It's over 100 years ago, actually, that the concept first appeared when the Sherry Netherland Hotel in New York launched some apartments, which it sold alongside its hotel on Fifth Avenue. But nothing happened after that. Actually, the Carlisle Hotel around the corner also did the same a few years later, but nothing else happened after that until the mid-80s. And it was Four Seasons who launched into this when they built and sold out their apartments next to its Boston hotel and thought, well, this is really rather a good idea. The first international branded residences was at Amanpuri in Thailand, which was in the late 80s. And then Four Seasons started growing into this. They bought the Regent Hotel portfolio in the 90s. Ritz-Carlton came into the 90s, principally focusing on North America. And then from 2000 onwards, we saw a steady stream of luxury hotel brands coming into the market. Some of the key players whose names are well known today. During that period, that decade of 2002 to 12, the number of hotel operators who entered this increased tenfold during that period. And then around 2010, we started seeing non-hospitality brands entering the sector. And that today represents about a fifth of all schemes in the market. And with the latest snapshot of where we are in the global market as of Q3 this year, We now have over 230 brands active in the sector. We've got 779 completed developments, and 967 in the pipeline to be delivered by 2031. And I've put at the end of this a question mark as to where this is going, and I'll come back to this later in the presentation, as to some thoughts about that. But to put this into data and to present it as numbers, this shows you the trajectory that the industry has enjoyed. Over the last 10 years, we've seen nearly 200% growth, 80% growth over the last 5 years alone, and the forecast growth is a further 82% in the next 5 years. So this trajectory is set to continue, picking up on one of the questions which was asked in the poll. This is going to happen. This is definitely going to happen. And this data is provided by my partners at Global Branded Residences, who have some really, really excellent data on all of the global projects, as indeed do Savills. And so there is a lot of intelligence out there that you can gain access to about who's doing what and where and so on. The leading players in the market, by group, we can see that Marriott are head and shoulders above. They've been certainly doing it for the longest, shortly followed by Accor, which is expanding its portfolio quite considerably, and very rapidly as well. And they are groups. Marriott, I think, has about 17 brands in the residential space, 16 or 17, and Accor about 26. But what's interesting is Four Seasons is third, and James Price is on the panel, who'll be speaking later. And they are, of course, a single brand. There is only one Four Seasons within the group. So they still have a pretty dominant presence in the sector. And then you see most of the well-known group names falling beneath. In terms of non-hospitality brands, which is the design company set up by John Hitchcock and Philippe Starck back in the 90s, is a clear leader by some significant margin in the sector. They have developments all over the world. They're still signing up deals, particularly in India and South America, very successfully at the moment. And they're followed by really quite an interesting group. You will see that it includes hospitality. Well, it includes design, it includes fashion, it includes golf, and even F&B. So it is an enormously varied sector, which really makes it tremendously interesting. It just shows how far this concept can spread. And if you look at Nobu particularly, they and Elie Saab, of course, a fashion designer, but Nobu started off as a restaurant, of course, has gone into hotels and hospitality extremely successfully and signing up some really impressive deals. But they've done it pretty seamlessly. And I just want to dive into this non-hospitality brands. It's fair to say that the industry was founded on hospitality. That's where it started. That's why the concept took off, so that people could live in this kind of hotel lifestyle in their own home. But over the last few years, we've seen more and more non-hospitality brands, what I call jumping on the brand wagon. And really, as I said, the range from fashion to publishing, automotive, F&B, fashion, and so it really does extend. And you wonder where the scale, even boats are now involved, and cartoon characters. It really has gone in all directions. And as I said earlier, it represents about a fifth of the global market. And the reason for this is because the brands have recognized that real estate can present a relatively seamless opportunity to expand and extend profitably their brand, using their design flair and their loyal followers. And developers are, particularly in places like Dubai, are actively seeking fresh brand options to introduce into the market. Now, on the right, there's a chart which I compiled from my compendium, which is kind of a snapshot of just which are the dominant sectors, and it shows you just how broad this sector has gone, and I think it will continue to go in different directions. Um, but there is a big debate about this, and I've sat on many panels and been in many conferences where people have questioned the value of a non-hospitality brand and what that brings to the whole lifestyle. And in fact, Scott Ansell, who's a well-known branded residences lawyer in the Middle East, in a recent interview, he said, with these entrants, the question must be asked, what is the brand promise that they can deliver? Um, and a lot of people are fairly negative about these non-hospitality brands coming in. But I remind people that this is a demand-led industry. If people didn't want these products, they wouldn't buy them, which would mean that the brands wouldn't get in on them. So as long as there is a desire for these aspirational lifestyle and fashion and luxury brands, then they will continue to appeal to a wide audience and really extend the sector and make it a lot more interesting place. Um, I've described this when I started analyzing this, when I wrote my first report, as a win-win-win scenario. It's a very unusual situation. It's this triple win where brands and operators they have massive benefits. They get revenue and expansion channels for their brands. They can extend into a very high ticket sector using their design flair and their expertise really to bring their brand into a new space and engage with both existing and new clients. For developers and investors, a key benefit is the ability to pre-sell units and generate revenue in advance of the project opening. And this is really important because if you're just building a hotel, of course, it's very important to remember you don't make $1 until the doors open on the first night. With branded residences, of course, you can pre-sell up to generally 3 years in advance. And of course, this helps commercially. It's a huge advantage. In addition to that, they get access to the brand's expertise and to its global loyal follower base and their loyalty networks. The other thing is that branded residents are proven to sell faster and also at a generous price premium over comparable non-branded real estate. And then we look at buyers, and there is a huge number of benefits that appeals to buyers, which is really what's been driving the market. As I said, it is a demand-led market, and I'll dive into that in a minute. I just want to talk about the point of premiums because this is something that is discussed enormously. I think it's sometimes taken out of context, and I would advise certainly to take it with a pinch of salt. And we can see here from GBR's data that their globally adjusted price premium is 37%. So that means if you have two similar buildings, one's branded and the one next door is unbranded, that arguably the branded one should be giving you an uplift of 37% on your pricing. But it does vary according to the type of project that it is. As you can see, for urban, for example, it's 24% urban resort to full resort, the full resort being the highest. But as I said, I would take these figures with a pinch of salt because it does depend entirely on the location. And the reason that this data is quite as high as it is because there are a lot of outliers involved here. We've got new markets, emerging markets, where you will see massive brand premiums because it's doing something new in that market. I remember when I first started researching my reports about 10, 11 years ago, I can remember there was a project in Puerto Rico, I think it was a Ritz-Carlton, which was selling at a 250% premium over the nearby non-branded stock. And we see this in emerging environments like Almaty, where we've seen premiums of over 100%. But generally speaking, in more mature markets, you will never see premiums like that. And therefore, it is really important that if you are looking into this, do not take these general figures that are bandied around in the press and expect that you can just stick 30% on top of your pricing and they will sell. It's not that simple. It really depends on many, many different factors: the brand, the location, the design, the facilities, the amenities, and so on and so forth. So many will undertake a brand premium study, which can be recommended. And it's interesting that Savills data actually comes in from their latest report at 33% globally. And I find this really interesting because when I again started researching this, it was Knight Frank actually who in 2013 produced the first paper I ever found on branded residences, and they highlighted that branded residences sold at a premium of 30%. Now that's really interesting because it hasn't actually changed that much. Even though the market has grown exponentially, it's always been around the 30% mark. That is something to consider. Take it with a pinch of salt, but be assured that the data says, yes, you can get a generous premium on your product. Now, I've highlighted this is a demand-driven sector. And in terms of the supply, why the developers are doing it and why the operators are doing it, there is a list of reasons here. And incidentally, this will be shared with you, this presentation at the end. And I know time is quite tight, so I'll be rattling through this. But there's a bunch of reasons as to why they do it. But from the demand side, you know, there's a massive awareness about what branded residences do. When I started researching this, a lot of people didn't know what they were. I had to explain to people, even in the industry. It is now mainstream, and most people do understand it. And there is a bunch of benefits which tick the boxes of many high net worth buyers around the world. And I drilled this down, I distilled it into two main drivers, convenience and confidence. And just to open up on those a little bit more, the convenience is the location, the design, the facilities on hand, the concierge services, the management, loyalty programs, and so on and so forth. It's basically this lock up and go lifestyle if you want it. Also, you're surrounded by like-minded neighbors, and this is a big part of what's driving this. John Hitchcock used to talk about sort of a modern day village, a community. And this is true. You're likely to be surrounded by people who think like you, particularly if they aspire to a particular brand. And then the confidence is the fact that there is a reassurance from an association with a recognized international brand. And this is particularly important if you're talking about emerging markets. So if you are building in a completely new destination, it is one way of saying, yes, we brought a brand in because it's the buyers will think that, well, that brand is not going to put its name on something unless it's going to be delivered to the high standards that I would expect from that brand. And then, of course, there's the management, the rental yields, faster sales, and so on. And so all of these come together in the pot to create this win-win-win situation between all the parties. Now, as far as brand choice goes, I mean, we've talked about the fact there's over 230 brands active in the space at the moment. And it's important to think, well, just slapping a name on a building is not necessarily going to work. Possibly in Dubai it might, but in other markets it really needs a little bit of consideration. It's got to suit the location, and it has to appeal to a particular demographic profile where buyers have to associate with that brand. And it's important to remember that some brands actually fall in and out of fashion. So this and the slide on the right, which is from 10 Minutes Hotels, is quite interesting because this is just the hospitality, and these are not all brands that are participating in branded residences at the moment, but it shows you just how much noise there is in the marketplace from hospitality brands. And one of the key themes of my reports has been differentiation. Is when you have such a crowded and increasingly expanding marketplace, How do the brands differentiate? How do particularly the hospitality brands, where there can be confusion about what the difference is, or rather misunderstanding amongst consumers about actually what that brand represents. So every brand is striving to offer a differentiated position and lifestyle, but many are asking how effectively is that actually happening? And there's a quote that I dug up, which I really like from a guy called Ricky DeBlanc, who is no longer with us, but he said 80% of CEOs believe their brand differs from the competition, but only 20% of customers agree with that. And I think that is a very good marker in the sand, because it will make people think, actually, we do need to stand out. And of course, if you're trying to sell people, you're trying to attract guests, it is really important to stand for something quite distinctive, so that people will associate and engage with your brand. Now, just looking ahead, I don't have time to run through all these, but I'm often asked, and I used to write in my reports some predictions about what I thought was going to be happening and so on. And I've listed down 10 here. I could have done more than this, but these are some of the things that I think, just to sort of wrap up, are the things that are interesting in this marketplace. Global expansion, well, I've already covered that. There's no doubt that the trajectory of the industry is such that it's going to be doubling and trebling. Now, brand proliferation. This is quite an interesting one, because in 2015, when I wrote my first report, there were 50 hospitality brands and 7 non-hospitality brands. And as of this year, there are 145 hospitality brands and 75 non-hospitality brands. So in only 10 years, we've seen hospitality brands triple, and we've seen non-hospitality brands increasing tenfold, over tenfold. Upscale, mid-scale, that is a really interesting sector, because there are, in my opinion, significant advantages to this. If you think of the market as a triangle, we're talking about luxury just in the top sector. There's a much bigger marketplace for the middle class, and it's really important to consider how developers will have access to much larger potential buying audiences, but also that many markets have rising middle class populations and corresponding wealth with it. And those are very strong demand drivers to underpin this. So I've been predicting for a while that the upscale, mid-scale sectors are going to be done. Luxury is a relative thing, so it will appeal to people certainly in lower tiers of that. Standalone, that's a big conversation. And in fact, HVS, when I interviewed them back for my first report, they actually said the majority of operators do not operate standalone residential products, and it is not a major consideration for the future. That was in 2015. And how quickly things change in this industry, because that was actually right at the time, because I spoke to many of the development directors who pretty much said the same thing. But today, 36% of global branded residences are standalone, and Marriott, for example, is planning to grow standalone to 25% of their portfolio. Accor's around similar in Europe and the Middle East, about 20 to 30%, and Hilton's looking at around half of its development pipeline. Wellness and longevity. These two sort of things merge together, but wellness tourism is the fastest growing segment of travel, and high net worth individuals rank longevity and wellness now as their #1 travel priority. It was interesting that a survey that was done said that nearly half of US adults were willing to invest in extending their lifespan and spending most of their discretionary income on health and longevity. And the fastest growing segment within this whole wellness ecosystem is actually wellness real estate. And GWI is predicting that that's going to exceed $1 trillion by 2030. And there is evidence that wellness-focused properties, residential properties, can command a price premium, an additional price premium of 10 to 25%. That's from RLA Consulting. So this shift extends into residential because green building and healthy living are increasingly overlapping. And the final one is senior living. 70 is the new 50, and I think there's a fantastic opportunity for brands to get involved in these slightly more mature residential enclaves, if you like. And we've seen this happen already very successfully, where 55 plus is selling out well. There's one quote I just want to leave you with, which again I dug up and I've used it in all my reports because I think it really encapsulates this. Experiential luxury is growing faster than personal goods luxury, and designer homes are a natural bridge between these two worlds. Is there any greater experiential product than one you actually live in? So very many thanks for listening. I hope you found that interesting.
Chris, that's great. Thank you so much for taking us through that. It was excellent. We are having some questions come in on the Q&A function, which will kind of encourage people to continue to use. I think we'll probably try and pick those up in the panel session itself. But Chris, thank you for that, and I'll hand over now to Chris from Bird and Bird, who's going to pick up on some of the legal considerations to take into account in this market.
Thanks very much. It's Simon, actually. Simon Price from Bird.
Sorry for that. I literally had one job.
That's quite all right. I'm a partner here in the real estate group, and like Karen Freeb, I work extensively on hotels, hospitality, and leisure deals across the world. Chris has outlined the market position for branded residences, and before we have our panel discussion, I'm going to be summarising the contents of the key agreements that are entered into between the developer, brand, and residence purchasers in relation to a branded residences scheme. The legal documentation for branded residences can be more complicated than for hotel deals because of the involvement of residence purchasers. This slide shows an indicative structure for the legal relationships between the developer, brand, and purchasers, although the exact structure can change on a deal-by-deal basis and will take into account local law requirements. The agreements between the developer and brand is similar to a hotel deal, but includes a marketing license or similar name, dealing with the brand's authorization of the sale of units under its name. The agreements between developer and purchaser can include direct agreements between the brand and purchasers on some schemes to give a direct license to use their brand, and for the details of a residence rental program or rental pool. The brand is not a party to the sale agreements to purchasers, but will want to have oversight of these agreements to ensure that the whole structure works. Ultimately, it's their reputation that could be adversely affected if the developer fails to deliver the product that purchasers expect. Before we launch into the detail of each legal agreement, it is worth looking at some of the issues that are relevant to structuring branded residences transactions. Firstly, this presentation refers in a number of slides to residence purchasers, but in practice it's common to have a homeowner association formed as part of the overall structure. This can be a regulatory requirement in some jurisdictions, in particular the US, where we have the concept of condominium associations. But even in jurisdictions like the UK, which has a much lower regulatory requirement, it's common for developers to create a homeowner structure. The homeowner association will be co-owned by the residence's owners, and in a wider scheme where there is a hotel, the association may be majority owned by the hotel owner with interests held by residence purchasers. The role of the association will vary from project to project, but often involves a formal group for liaising with the developer and for approving annual budgets. The formation of the rental program or rental pool is a key part of the deal for purchasers who will want to ensure that they can have an income from the residence when it is not being used. I'll say more about this at the end of the presentation, but the key structuring point is that the marketing of some rental pool arrangements may be subject to securities laws, which the developer would need to comply with. This is particularly the case for the US, and although there are ways to structure the deal to reduce the impact of securities laws, the key thing to remember is that this would apply to marketing to investors who are located in those jurisdictions, like the US, regardless of the location of the residence project. Most residences are managed by the brand that applies to the project, and so this presentation assumes that the brand is also the manager of residences. But there is a growing trend for branded residences to be managed by third parties under franchise arrangements. And as for hotels, there is a likelihood that this will grow as more residences are built. Chris referred to brand proliferation in his section on trends. Exclusivity is a key commercial point in any residences deal. This will be for the benefit of the developer, who will want to ensure that the brand residences are the only residences under that brand, and sometimes for similar upper scale luxury brands in the same group within a defined radius. There may be separate exclusivity periods for residences as part of a hotel complex and those which are standalone. The brand may want the exclusivity provisions to fall away when a certain proportion of the units have been sold, or sometimes on a fixed long stop date. The final point on this slide relates to termination of the brand license. This is an important consideration for the purchaser of a residence. They may acquire the residence on the basis of its connection with a particular brand, but that brand may fall away over time if the residential management agreement either expires or is terminated. The developer, or by that stage the homeowners association, would then need to bring in another brand or manager to ensure that the relevant services are continued, albeit under a different brand. The marketing license is the key document that deals with the marketing and sales of units and the brand's authorization of the process. The license fee that the brand is entitled to is based on a percentage of the gross sale price of each residence, probably in the range of 2.5%, although I've seen considerably more, depending on the brand and the project. Upscale or luxury brands will want a high degree of control over the sale process and materials, including the right to approve the sales agents, marketing brochures, images of the scheme, use of its logo, even locations where the units are being marketed to, and sometimes many more details as well. It will want the ability to terminate the marketing license if the sales of units do not keep up with a set timetable and it looks like the scheme won't sell many units. It will also want legal protections, including developer indemnities, so that it has a right of claim if the marketing license is breached and harm is caused to their brand. The technical and pre-opening services agreement will be similar to an agreement for a hotel of this kind, with the brand given rights to approve the overall scheme and details like room decoration and equipment, so that they would comply with brand standards. In advance of opening, the manager would be responsible for hiring and training staff, while the developer would be required to approve the budget and inspect the final completed scheme to ensure it's ready for operation. The same applies. Next slide, please. So, the same applies to a residence management agreement, which, like a hotel, will deal with employees' budgets, setting out the services to be provided. The fees payable to the manager and the FF&E reserve it is entitled to retain will be based on the overall budget for the management rather than on income. Next slide, please. Finally, in this section, we'll look at the agreements between the developer and residence purchasers and the brand manager and purchasers or homeowner associations. I don't want to be too prescriptive in dealing with the contents of these agreements and how they are documented, because the details of the sale documentation will be based on local law requirements for the sale of an interest in land and for the obligations on the developer to complete and finalize the residences and common parts, which may include a turnkey development of the units to an agreed standard. The agreements may also deal with the purchaser's share of a homeowner association and other relevant governance details. The purchaser will be careful to ensure that the deposit and purchase price provisions don't allow the developer to have access to substantial amounts of its money until the scheme is completed. Again, regulatory requirements in some jurisdictions may protect the purchaser's deposit by requiring that these are held in escrow, but at least the purchaser would want transparency over what's happening with its money. The sale agreements will also impose a number of ongoing obligations on the buyer, which may, depending on the scheme, include a requirement to observe residents' obligations that apply to the whole scheme. This could be to avoid anything which detracts from the enjoyment of other residents, anything from noise, restrictions on the admission of guests, even to the way that balconies or gardens are furnished. There may be restrictions on subletting, particularly where this may compete with a rental program. And sales of units can be restricted to ensure that the materials or choice of agent are in keeping with the brand, and some registration or other approvals for the monitoring of residence owners. Importantly, the residence purchasers will want to ensure that they have ongoing access to all the facilities and services that have been advertised, whether that means access to pool and spa facilities at the residences or an adjoining hotel, cleaning and maintenance services, rights to have room service and other rights that might be enjoyed by a hotel guest. It's often very bespoke to the scheme, and it's important, as I mentioned earlier, that the purchaser understands how any of the services, facilities, or use of the brand may be terminated or changed in the future. Next slide, please. That's it. And finally, the services offered to purchasers may include the ability to participate in a rental program or rental pool. The difference between these is whether the purchaser gets income from the use of their own properties or whether they get a pro rata share of the income from all properties in a rental pool, although rental pools are less common than rental programs. Now, these vary based on the jurisdiction, but generally involve the residents being added to the inventory of an adjacent hotel or being let as a standalone residence. The manager will deduct its management fees and other expenses such as facilitation and cleaning fees from any income that's paid to the residence owner. In order to participate in the rental program, the homeowner will have to ensure that its property is in keeping with brand standards at all times, which may include things like style of decoration, furnishings. Now, this has been a fairly brief treatment of a very complex area, and so I'd be delighted to discuss it further with any of you if you wish to contact me after the webinar. But thanks very much for listening.
Great, thanks, Simon. Lots to contemplate there. There's great gains to be pursued, but it's not straightforward. So I'm going to hand now to Karen from Bird & Bird, who is going to chair our expert panel. Thanks, Karen.
Thank you very much, Graham. So if I could invite my panelists all to appear on screen, that would be great. And meanwhile, I'll just introduce myself briefly again. I'm Karen Freeb, head of Bird & Bird's International Hotels, Hospitality and Leisure team. And before introducing the panel, again, to remind you who they are, I'd just like to give you 4 key scene-setting facts, which I've taken from Savills 2025 annual branded resi report to get us going. And this has already been referred to by our speakers. So first of all, the total number of global branded residences schemes is expected to rise from 764 as at December 2024 to 910 at the end of 2025. So this reflects an astounding 19% growth year on year. Thirdly, the current pipeline of branded residences spans over 90 countries, 25 of which are launching their very first ever branded residences development. And fourthly, the number of players who are active in the sector is also on the rise, with 39 new hotel brands and 19 new non-hotel brands entering this space. So no wonder the field of branded residences is one that is attracting intense scrutiny and interest. We're fortunate today to have 5 distinguished experts on our panel, and they will be discussing their own experience of the branded residences market and share their insights with us. So to recap on who they are, we have James Price, Senior VP, Residential Development, Marketing and Sales for Four Seasons. JD Menezes, Regional VP for Mixed Use Development for Marriott International. Deepesh Thakrar, Managing Director of Debt Finance at Oak North. Ina Plunian, Senior VP at Cedar Capital Partners. And Aoife Roach, Regional VP for EMEA at STR. So I'm going to focus first on questions for our brands, represented by JD and James. Then we're going to really move on to the investor and developer, or mostly the investor perspective, and finish with some comments from Aoife, or some questions for Aoife, who, of course, is at STR and specialises in data and benchmarking analytics. So first question, which I'd really like to pose to JD. What motivates so many brands, JD, to extend into branded residences? Is it primarily a diversification strategy, or is it a loyalty driver, or a revenue enhancer? Perhaps you could enlighten us.
Thanks, Karen. I think it really comes down to all three things: diversification, loyalty, and revenue. And the category in general is growing because our view is that all three sort of reinforces each other. If you look at diversification, I mean, we aren't in the business of just selling hotel rooms. We sell lifestyle, we sell trust, and we sell a certain level of consistent service standards. The branded residences as an extension of our hotel business allows us to extend the St. Regis, the Ritz-Carlton, the W experience into your home versus just a transient stay. If we look at loyalty, buying a branded residence, in our view, is the ultimate expression of loyalty. These owners are our most engaged customers. They interact with us every single day, multiple times a day in their communities. And many of them are our valuable Bonvoy members. From a revenue point of view, it's definitely revenue enhancing for operators. If you look at the two major fee streams, there's the royalty fees on the front end, which are linked to sales. These tend to be high margin fees. And then on an ongoing basis, you've got long-term, stable, recurring management fees without the volatility of hotel occupancy cycles. So these three factors are all interlinked. And finally, I think one of the big things, one of the big benefits really is to developers. As Chris Graham outlined, higher price premiums, faster sales velocities, and ultimately improved project returns. So the incentives are aligned across the ecosystem, which is why we continue to see the category accelerating.
Thank you very much. And James, I'd like to turn to you now, and perhaps you'd like to comment on that, but also let us know how you decide which markets or projects really fit your brand DNA for residential expansion.
Thank you, Karen. Good morning. Good morning to everybody that's joining the webinar. So I think that when we look at this, as Chris mentioned earlier on, we've been in the business. We're actually celebrating our 40th year of managing residential properties. As Chris mentioned, Boston in 1985 was our first project. And we've expanded, obviously, since then to the point where, as we sit today, we have 59 projects which are open and operating around the world. And we're expecting that to sort of grow to north of 80 by 2030. So there's a very strong pipeline to come as well. Growth is one thing, and the size of the portfolio is measured. And Chris mentioned some of the kind of the advisors that comment in this space, and we always look at that in terms of where we sit against other brands. But it's a qualitative thing as well, and we want to make sure that the brand is seen as being in the best locations. So we work very closely with our business development teams. We have a very clear strategy around markets that we want to be in. We want to be in high value markets. Ultimately, developers need to create margins when they're building. And so the higher the price points, the better the quality of the offer that you're going to get. So it's important for us that every new project that comes along sort of meets those brand standards. Simon mentioned earlier, a lot of the kind of the agreements and the time that we take in the development phases of a project are around ensuring that those standards are met across every touch point that a buyer will have. So we do, actively get involved in the design stages. We're obviously actively involved in how this is going to work and feel for a resident. And it has to deliver on that brand promise, which we've spent, decades putting together. So we're very strategic in terms of where we want to be. We're very fortunate that we do get approached a lot with projects, but we're very selective about, as I say, which ones we want to work at and which locations we're going in. Funnily enough, when you look at brand premiums, and again, this is a point that Chris touched on, if you're in the strongest markets, they're likely those are the most competitive markets, and you're going to have a range of very good, strong competitors in that market. So your brand premium is not necessarily going to be as marked as if you're going into secondary or emerging markets. So keeping a brand premium is important. But in a way, if you're focusing on the best prime markets, that premium isn't going to be so pronounced. So we do have to balance that, and how the brand is regarded reputationally is, yes, are they getting the price premiums? That's important. Again, we track that very carefully, but also being in those right markets where we can deliver on that brand promise is important to us.
That's really interesting. So I was reading that there are some locations that are really ground zero still when it comes to branded residences developments, like Paris, for example, Hong Kong, Monaco, which are yet to be cracked and must be some of the most desirable locations.
A lot of those are very, very hard to unlock.
Heavily regulated, I believe, yeah.
Heavily regulated, plus also finding the right
products.
opportunities. I mean, in terms of looking at the European sort of city centre markets that, are very brand accretive, you still need to have the right location. You need to have the right scale. On the questions earlier, when people said what's most important, location ultimately still is the key thing, and the brand adds part of the layer cake of a value of a property. So getting the right location right is still paramount, and having the right location with the right scale of property is a hard find in a lot of those markets. So that's why you don't see necessarily the leading brands sort of, as abundant in those markets as you might see in other regions around the world. But you can also be very nicely surprised. You can go into sort of emerging markets. Remember, when I opened up the property in Kyoto, when it started going into sales, there was nothing really like the Four Seasons offer in that market. And I didn't really recognize at the time that Kyoto was seen as such a gem. And the price points we achieved were second only to London at that time across our global portfolio. So, you have a pretty good idea about, where price is going to be, but you can be surprised a little bit along the way.
Right, thank you, James. And JD, just coming back to you, Marriott obviously has a very extensive portfolio of brands. How do you, Marriott, decide which brand to deploy each time?
So we have about 300 projects globally, about 160 that are open and about 150 in the pipe. And if you look at across all our 32 or 33 brands in the entire portfolio, we look at branded residences for our premium brands and our luxury brands. That's essentially half the portfolio. So we've got about 16 brands that we could look at for branded residences. I think when we're looking at any project similar to James's kind of screening process, the fundamentals remain the same, right? So most important for us is developer credibility, whether we're looking at a Marriott residence or a Ritz-Carlton or an Edition, especially in Europe, Middle East, and Africa. There's a huge number of markets. The sector is fairly new and not as institutionalized. So developer credibility is critical. We need a partner with a proven track record, with the ability to deliver, not just from a design point of view, but from a quality, and ultimately deliver what actually has been sold. So that's number one. Second, and James talked about this, is the brand market fit. When we need to be sure that there's a real depth of demand for the brand that is being sold. Whether it's an Autograph, whether it's a Ritz-Carlton or a Bulgari, we've got to be comfortable that the pricing is achievable and that there's enough depth in the market for projects to be successful. The third piece is obviously from a design and servicing potential. That's the third fundamental, again, regardless of brand. We need to be sure that the site, the concept, can support our ability to deliver the level of services that the brand promises, right? So in terms of layouts, amenities, the back of house flow, and just F&B and just how it all works. I think those are the three things. And if these three align, we've got 16 brands to look at. If they don't, then we've got no brands to look at.
And what sort of advice and guidance and support do developers require, and how do the brands support them? And do you think that's evolved post-COVID? And perhaps both of you could comment briefly on that.
Sure. I think, we've been pretty consistent, whether, pre or post-COVID, in terms of what we provide as a brand to this. And I think that this rests predominantly on the fact that we've always been the property managers on the project. So when you're buying a Four Seasons project, you're getting Four Seasons looking after you in the long term. So the work that we do, and Simon laid it out very well in his presentation there, the work that we do at the front end is, yes, partly sort of helping the design, but as JD just touched on, the design is also informed by how we're going to deliver that service standard. So all of those areas that, we're thinking about when we kind of build that watch, if you like, that is important to us. But it starts with the governance. And as Simon mentioned, this is, baked in local law. We have certain things that we need to make sure that it delivers for Four Seasons to be that property manager in terms of the structures that are put in place, the rights of the homeowners through a mixed use project, in a standalone project, how that's going to work, how HOAs are set up. Ultimately, we're going to be managing those. We are effectively the asset manager for those properties. If you take the portfolio that we've got now, we're effectively the asset manager for over $30 billion worth of real estate.
Wow.
So, that's the way that we look at that. And so we have a responsibility. Yes, we want the brand to support the developer at the outset from the sales standpoint. We want that to be successful. That's hugely important to the brand reputation. But the reputation in the long term rests on how we deliver our management and our services, and that's how we get judged. And there are certain ways in which you can do that through, engaging with the residents, the homeowners, to check how they're doing. So we do resident surveys and look at, areas that we're doing well, areas that maybe we need to sort of focus on a little bit more. But also when we look at the resales now, and as I've said, you've got a lot of properties which have been established for some years. So we're quite fortunate that we have quite a low turnover rate through our portfolio, but when things do sell, we track and monitor how those resales values are holding up. And it's, again, a very strong story. And that ultimately is the proof, I think, in terms of, are you doing well as a brand by the homeowner? And it comes back to everything that was being said earlier. What is the value proposition that you're making here? And, for us, it's very clear that Four Seasons as a hospitality brand provides that same level of management, asset control, and of course, those services to the homeowners. That's the promise. That's what we have to deliver. And so that's a key part of what we're focused on. And when we build a project with the developer and other stakeholders and parties, the legal teams, we're thinking about how this is going to be 10, 20 years down the line.
Great, because after all, I think one of the dynamics here, isn't it, when you talk here about hospitality providers, which is that a lot of the non-hotel brands who are going into this market, the question is, can they really provide the same kind of benefits that the pure hospitality provider can? But I'd just like to bring in JD there, because just on this question about developer support, JD, I see that Marriott has recently launched its Onvia, is it a platform to support these projects? So that's quite an interesting development.
Yeah, we launched Onvia about a year ago, which is our which is our owner recognition program, which houses all the benefits and services and amenities that are available to all our purchasers globally.
Great. And just one more question, really, for both of you. In terms of the future, where are your key growth areas for branded residences? And do you think we'll see more movement from luxury brands to mid-scale and lifestyle? JD, I've got you on screen, so would you like to comment on that first, please?
Sure. I think Chris touched on this one. I think we're seeing kind of two major trends, and we have over the last kind of 5 years. One is standalone residences are just exploding. It's the biggest shift in the sector. Buyers want the brand assurance and service standards without paying for the hotel overhead. And developers want the brand assurance and being able to provide service standards without having to build a hotel. So I think we're seeing really high growth of standalone. About 5 years ago, standalone was probably 10% of our pipeline in Europe, Middle East, and Africa. And today it's about 40%. And we see that continuing. The pipeline for next year looks strong on standalone as well. And for us, it's definitely the fastest growing category. The other shift we're seeing is not necessarily a shift, but we're seeing a faster growth on premium versus luxury. So luxury continues to go fairly strong. So Ritz-Carlton, St. Regis, Edition, and W, and those brands continue to grow strongly. But we're also seeing huge traction with Marriott, Westin, and Autograph in our premium segment, both co-located and standalone. The brands we're finding continue to deliver premiums over unbranded, and they have lower build costs. They still have the back end and infrastructure of Marriott when it comes to design, operations support, and marketing support. And so we see that continuing to grow.
Right. Thank you. And I would just like to say we do have quite a few questions coming in. Most of them, from glancing at them, I think we will cover in our Q&A. But perhaps James, if you'd like to come in on that question here. And one of the Q&A questions that's come in is, why would brand not be relevant in Dubai?
Brand is relevant in Dubai.
It's an interesting question.
And funny enough, to sort of meld those questions together. So we, like JD said, we see huge opportunity in the standalone space. We have 2 standalone projects in Dubai, one open and operating, another one in development. We also would extend that to UAE. We've currently got a project which has just launched on Saadiyat Beach in Abu Dhabi, which has been hugely successful in terms of the initial sales and the traction that that's getting. So, that attests to what Chris was saying earlier around the power of the brand to sort of drive interest and appetite at the outset of a project. So very much we see the UAE is continuing to be an interesting market for us. But I think this also addresses the other part of your question, Karen, which is where do we see the brand? People often say, are you going to do 2 seasons? Are you going to do 3 seasons? Let's be clear. No, we are 4 seasons. And I think that, we have a very sort of fortunate position, but it's a position which has been nurtured over decades, whereby the brand is very clear. I think people understand what the brand provides. And residentially, we're going to be part of the same, it's one brand across the whole business. So whether that be our hotels, whether that be what we're sort of doing and pushing into yachts, whether that be the jet, those experiences that we provide to people extend into the residential space. And it means that we have to keep a purity around where the brand is. And that control that I mentioned earlier about being on the best projects, I totally agree with what JD said earlier about having the right partners as well. That's critical. That control that we bring in is everything. It's all about the brand. We have to protect that and maintain that. So we're going to keep ourselves very kind of pure and focused in terms of what 4 Seasons as a brand delivers across the spectrum of products and services that we have, residential being one of those. And that means we will focus on the right markets. Now, somewhere like Dubai, we know that there's a huge proliferation of brands. Miami, no different. Bangkok going the same way. These are markets which are very competitive, but it is right to be in those markets. It's just that you pick very carefully what project you're working on. And what we would say is that at the sort of the top end of luxury, we're never going to do huge schemes. The largest scheme we've got is in Bangkok, which is 366 units. Generally, our project size is around 70, 80 on average, and that includes our standalone projects in city centers. We do see an opportunity for out-of-town standalone community projects, which might be larger in number, 150 units, that type of thing. But the scale of those keeps a balance between what's exclusive and also having sufficient scale in order to sort of sustain all the amenities that you want to put in place to make it best in class. So I think hopefully that addresses some of those points. But we see very much there's a future in those markets. But it's keeping,
No, so thank you very much. We're very fortunate to have 2 of the major brands in this space on our panel today, represented by James and JD. And thank you very much. I feel we're only scratching the surface with some of these topics today. And this is our first webinar on branded residences. But I do feel the more we speak and the more I see the questions, we probably should do more of these, have a deeper dive into some of these topics. But now moving on to investor perspective. So I really would like to turn a bit more here now to Deepesh and Ina. And my first question for you, perhaps Ina, you'd like to kick off on this one, is what do investors actually look for when they're looking to fund one of these branded residence developments? And how do people make proposals stand out to an investor?
Yeah, absolutely. Hi, everyone. It's lovely to be here, and thanks to everyone who's taken the time to listen in as well. Look, I think I don't know who said it at the beginning of the session. I think it might have been Chris, that the reality we're faced with as hotel developers, as hotel investors, is that we don't make a euro, pound, or dollar until we open the doors to the hotel. And you know, that issue in many ways has been aggravated, if you will, over the last few years with, you know, the reality of what the construction environment looks like in many markets, not only across Europe, but globally. You know, we've all spoken, I think, at length over the last few years on, you know, what construction labor shortages, increase to material prices because of supply chain disruptions look like. And all of this has direct impact, obviously, on, you know, project execution timelines, as well as the, you know, construction budgets we're faced with. And that does pose risk and issue to investors that in many ways, when it comes to ground up construction in particular, are really, really IRR driven and focused when we think about our investments. So I think the reason branded residences, from our perspective as hotel investors, is becoming really, really topical and important to think about, because it's a key way for us to unlock and de-risk projects, if you will, right? Being able to sell residences, again, off-plan well ahead of hotel openings, 2-3 years, I think was mentioned. Earlier means there's earlier cash release. That means that, you know, we reduce risk upfront. It alleviates it pushes IRR, and it alleviates just risk exposure. And that is true across the capital stack, right? I think Deepesh will probably be able to speak to that in a bit more detail later. But it also means that, you know, the depth of debt providers as well that you'll be able to deal with, because, you know, there's more confidence that that schemes can be de-risked earlier in the process, opens projects up for, you know, maybe more senior lending, or deep, you know, allows kind of margin reduction. So it's also a way to kind of find a more favorable and less costly capital stack in developments. And then the last bit I would offer up just as consideration is also that, depending on how the scheme's laid out, it's quite typical that we see, you know, phased development of residences well beyond the moment in time when the hotel is opened. So that there's a, you know, initial stock available that you can then continue developing out, meaning that there's also longevity of cash flows throughout the investment life cycle beyond just the early stages, which, you know, makes for really attractive investment profiling from our perspective.
Great, thank you. Deepesh, would you like to comment on that? And perhaps you could also address for us whether you think branded residences are actually living up to the promise of delivering price premiums and stable returns, or do you think the premium is being eroded as supply grows?
So it's interesting. So if you think about what we are as and what we do as lenders, we lend on hotels, and we do construction of hotels. We lend on residential developments and residential property, and kind of in between that, we also do care homes, and we also do senior living. And Chris alluded to senior living during his presentation. But if you think about where the senior living market is, typically what we've been able to do is fund the premium end of the market, and therefore there's a premium attached to normal residential prices. But that needs to come with some kind of product, not just the building, or not just the village, which has just got certain demographic of people. So when you take all of that across the spectrum, and you think what a branded residence needs to look like, or branded hotel residence needs to look like, what we're looking for really is, has the developer or the sponsor done this before, and have they got some form of track record in delivering this? I guess why you were probably seeing a lack of residential development, amongst many other reasons, taking aside the planning system, is build costs are astronomical, land prices are astronomical. and GDVs are probably still a little bit variable, and therefore something needs to give somewhere in order for us to be able to develop residential property. And this probably seems like a sensible or an interesting way to go. Obviously, there needs to be the demand, and you just have to look at the Six Senses in Queensway Bayswater, which is selling. One of the things that we have to consider is the tail post development or post PC, because if you take a normal residential development or you take a normal hotel, you probably say 18, 24 months you're typically out or stabilized, one of the two. Whereas I think with premium senior living, premium residences, and branded residences, it probably takes nearer 5 years for you to be able to really sell off all the units. So that's a real key consideration. So it comes down to, is there the holding power for the developer and sponsor? And is there the market penetration to take up these type of properties? Now, for me, the Six Senses doesn't feel like an obvious location for a branded
interesting location.
I mean, it's the building's fantastic. It's amazing, and the kind of pounds per square foot that they're actually achieving there is massively beating the local market. I think normal new build residences are achieving somewhere between £1,000 and £1,500 a square foot. I know there's some new things going up that will probably be around about 2,500, whereas the Six Senses are achieving closer to £4,000 or £5,000 a square foot.
And that's despite the fact that the service charge prediction.
And I would just gonna, and I think one of the things that we'll probably talk about is what are the major considerations, and one of the major considerations has to be service and management charges. Because that's you're spending however many million on an apartment, but then the ongoing cost and upkeep of that, because it has to remain premium. So all of those things together are what we really try and look at.
Yeah. So those specific risks that you've highlighted, a couple of them there, service charges must be one of them, management fees. What other specific risks do you think are built in here that owners in particular need to understand? Perhaps both Ina and Deepesh, you both comment on that.
Yeah. You go, Deepesh. Go.
Sure. I actually think there's one key underlying risk, and if you think about new build residential developments and you think about the secondary market associated with that, is if you buy something for, let's just call it £5 million, and you come to sell that in 5 years' time, is it going to be worth, or at least worth, £5 million? Because you've no longer got the new build premium. You've had the building and the residences been in there for a period of time. You would hope that you get normal inflationary growth, but what you're seeing sometimes, including in London, is the secondary market doesn't actually show an increase in value, and some are being sold at a discount, which is obviously disappointing, and that's just simple supply and demand demographics.
It must be a key concern for a buyer, clearly.
Absolutely.
Ina, do you want to come in there?
Yeah, absolutely. Look, to build on this, I think when we speak about service charges, fees as risk factors, I think what I understand by that, at least, is kind of, do we have a partner, from brand and operating perspective, that is transparent and able to articulate kind of what it is that will be charged at what stage in the process, and are we able to underwrite that appropriately and get confident that the transparency is available throughout kind of the chain, to us as developers as well as to ultimate buyers. And I think that's very easy to, and I like one of the Q&A questions in relation to this is like, we like to think about premiums and velocity. So, that is not to say that we all should go build branded resi because it's so easy. There's complexity attached to it, and we just need to make sure that there's alignment here and there's clarity, and we're able to articulate what's happening at what stage in the process. And I think that goes well beyond kind of just what does the service charge budget look like and what fees are being charged at what stage in the process, right? It goes really back to the fundamentals of, we're looking at, a development in this particular location. Who do we think we are going to be selling to ultimately? And do we understand their intentions? And do we therefore design a product that is going to be relevant to them? And do we therefore find a branding partner that has brand equity in that feeder market that we're going to be able to sell? So I think, to me, the key risk here is to kind of fall into this, great, we're selling fast at higher premiums, off we go, not a problem. It's forgetting that there's material complexity and nuance attached to kind of to the development of that, also driven by the sheer amount of stakeholders involved in getting this set up. And that's not to discourage anyone. I think to some extent that's the fun and the beauty of this, because there's material value creation to be had and to be made. It's a complex scheme to get off the ground and to align and to get going, and to make sure that
clarity as to your market.
Exactly.
I think you've touched on that. That's so important. You made me think there of companies like Riverstone, who are crystal clear as to who they're going after, and very much the North London sort of senior living market. And they have special facilities set up, invite people along to do the sales process. So, I think clearly that's something that you would be very interested in. But I just wanted to ask you both what regions or segments, and we have touched on this a little, is it luxury, wellness, resort, urban, members club, or something with gastronomy related features? What do you think look most promising from an investor standpoint today?
I think that always depends on who you are and
All
what
of
your
them.
mandate is to go and do. I think there's no universal answer to this. I think from our perspective and kind of the work that we do as an investor, I think biggest opportunity for us remains in branded residential that's co-located with and usually that's luxury and resort development on top of that. I think in Europe in particular, that's one of the markets where, branded resi supply remains very, very scarce, but where there is significant buyer appetite, because we are looking in a lot of instances at lifestyle-driven, brand association-driven buyers that are keen to look at second, third home product in key resort destinations in Europe. So for us, that remains a major focus when we think about markets. But that's specific to us. It's totally possible for others to take a different view depending on kind of where they sit on the risk metrics, and also kind of just what the mandate is that they're working with.
I think I think there's definitely demand across all segments within that. What we're seeing is really the luxury end of the market is really interesting for us, because we fund a lot of hotels, one of which being Beaverbrook, which is in Surrey, which is a fantastic hotel. And if you look at what's happened over the last 18 months or so with cost pressures, both in terms of national insurance and wages and food and beverage and everything else that comes with it alongside taxes, whether you're paying for that end of the market, whether you're paying £700 a night or £750 a night, for that market doesn't really matter. Whereas I think the more affordable end of the market, where there is definitely cost pressures as well, if someone's paying £150 or £165 a night, they probably feel that a little bit. So for me, the luxury end of the market is always going to be quite interesting, whilst I would say not in a recession. Clearly, as you enter into a recessionary environment, it becomes slightly more challenging. But in terms of hotel branded residences, you'd argue that the more I think it comes down to location. If you put a luxury branded residence in somewhere in, I'm not going to use a specific location without offending anyone, but somewhere where there is literally no demand for it. Whereas if you put it in the middle of Mayfair or even the middle of Bayswater, at least you're accessible to Hyde Park and some of those desirable locations. So it will always carry some level of demand.
Great, thank you. And I'm really keen to get on to Aoife, but I'm just going to ask each of you, Ina and Deepesh, maybe in one word if you can, maybe two or three. Do you believe that the branded residences model will remain resilient if the property cycle turns, which we all know it does for every few years, or interest rates stay elevated? Ina, what do you think?
I would like to think that in real estate, discipline wins, so that if
Love that one.
Well, it should. But if you have a well set up investment that's as Deeper said, is in a good location, has evidence demand drivers, has product brand alignment with that demand, then I think there's a strong sense that something like this can be resilient through market cycles. And the more you move up on the opportunistic scale, the more fragile that can become.
Quote of the morning so far in real estate discipline wins. I can see that featuring in Russell's summation of this session. Deepesh, very briefly, please, from you.
Yeah, I think you just have to look at Dubai, and clearly Dubai is a booming real estate market now. And you look at, I think there's a Chelsea Residences that's being or has been launched, which is quite interesting. I think it comes down to location again. Per my previous point, as long as you're in the right location, I think there's always going to be demand.
And providing the right facilities for your target market. Lovely, Aoife. Really like a few words on STR's take on the market. So what do you think the strategic drivers are behind the growth of branded residences globally? What have you seen from your research and the data that you've collected?
Well, hi, good morning, everyone. I'm probably going to help you, Karen, by summarizing, from all of the great conversation that we've had today. I think there's many trends and strategic drivers that are underpinning this growth, and I would pick three. I think one is just the hotelification of real estate assets that we're seeing as a trend. Hotels are the benchmark for service, for design, for operational excellence, and we can really understand with that why branded residences are growing and why they're successful. I think, we've talked a lot about luxury, but also gone into the other classes. Ultimately, a brand needs to integrate themselves into a person's lifestyle. So this is, the stage for any brand to be able to integrate themselves and their multiple brands and services into someone's lifestyle. So I think it just seems like the perfect formula. And therefore, the projections for the success of branded resi I would think are accurate. And then I think the third one, of course, is just structural wealth. If you think about the demand for luxury travel and tourism and how that is projected to grow and how, aspirational travelers will pay for luxury travel. And then obviously we've got, ultra high net worth individuals as well. So I read a McKinsey State of Travel report, which is from 2024, but I think still very, very relevant. And, they talk a lot about the future of travel and tourism, specifically luxury travel and tourism, and they projected 10% compound annual growth rate between 2023 and 2028, which is a very short period of time to see that further growth. So I think there's so many good trends out there to support this.
No, that's brilliant. And the demand for luxury, and more specifically branded luxury, really seems to have evolved, doesn't it, over the years? Is that something collecting specific data?
Yeah. I mean, certainly from a hotel brand, so we don't collect any data on branded resi specifically in terms of performance. But if we look at brands, over the last 25 years, branded room count has grown by 73% in Europe. So it really is, du jour. Brands are hugely important. There is an attraction for operators to leverage the power of a brand, but also the consumer sees the value of the brand, and that spans across all classes. Certainly, there's still a lot of independent opportunity and lifestyle opportunity in the luxury space, but brands are hugely important. And then if we just look at luxury as a whole, luxury performance, the recovery post-COVID has been phenomenal. We've all seen that in the numbers, although it did take 5 years for demand to fully recover in the luxury space because we had a lot of new supply is also coming in. Rates recovered within 18 months, and those rates have grown by almost 50% since pre-COVID, so since 2019. And if you compare that then back to the global financial crisis, so the most recent major blip that we had, it took far longer for the rate to recover. And when the rate did recover, it only grew by 3% on pre-GFC. So, we really are in the golden age of travel and in the golden age of luxury travel specifically. So I think, definitely if you put that into context, you can see where branded residential is going.
Fantastic, thank you. We have quite a few questions, but I'm afraid to hit our time deadline, which we always, as those of you who are regulars to these webinars will know, we do like to keep to time and not overrun. but I think we will be able to perhaps assist the questioners with some of the answers post this webinar, but we will look at them all. I'd like to just finish off by asking each of my wonderful panelists, as a takeaway for the audience, what is your own personal top tip for a successful branded residence project? I'd like to start with Aoife, please.
So it was touched on quite a few times through this conversation today, and the mid-scale segment and the opportunity not just sitting within the luxury space. And if I think about luxury, I think what's important for luxury is exclusivity and its craftsmanship. So if we think about fashion brands, etc. But then we look at the lifestyle side where, the Gen Z and millennial opportunity and that aspirational traveler, there is huge opportunity there as well when you factor in experience and community. So what is important for those two types of travelers and eventual buyers? I think that's where the opportunity lies. So there has to be opportunity across different classes, not just for luxury.
Brilliant, thank you. Ina?
Probably to just get the right team on board as early as possible to make sure there's clarity, transparency, and alignment between all parties and stakeholders. As we discussed, our view is that the potential here is immense, the value from a value creation and a return perspective, but the way to get there is complex and is multifaceted. So it's important to make sure everyone's is experienced and on the same page.
And definitely, I think room for a deeper dive on a number of these topics on a webinar or two in the future. Deepesh, what would your key takeaway be? Top tip, even.
Sorry, I was on mute. For me, delivering the right product in the right location with the right demand metrics.
Excellent. James?
I think it's just been said already. Location, partner, scale, design, and for the long term, management. And management comes back to a point that was discussed earlier around service charge. You have to be transparent. You have to make sure that people are very well aware of what this is going to cost them in the long term. And the long-term health depends on having things like capital planning, so reserve study funds, etc., things like that included in that service charge. But those 5 things.
I think that transparency point is really, really important, isn't it?
Mm-hmm.
Thank you very much. And JD, to finish, please.
I
This will
think
be the knockout.
one
You
top tip,
have to give us the knockout top tip here because you're the last
well,
person.
I'm not sure about knockout, but I think one top tip for developers is to really focus long term when they're developing these projects. So look 30 years out when you're building these projects, because I think it kind of summarizes everything. We've got to get the brand right. We've got to get the legal structure right. You have to get the product right. All the points that have been mentioned. But I think there's a lot of flash in this market, especially market like Dubai. Deepesh mentioned a couple of the projects. So there's a lot of flash.
Lots of flash.
Flash meaning these flashy projects that are selling out,
love that.
And non-brands, no real operating infrastructure, service infrastructure behind it. And I think that can give the sector a really negative reputation. And I think it's important that the hotel brands stick to doing what they do best, which is focusing on design, being able to operationalize and deliver services and amenities.
And hospitality. And hospitality.
Yeah, and hospitality. So that's my top tip.
I love that. Don't focus on the flash. So with that, thank you very much to all panelists, James, Deepesh, Aoife, JD, and Ina. You've been absolutely wonderful. And we hope to be able to welcome you back on a future panel on this topic. Lots to talk about. And with that, I'm going to hand over to my friend Russell Kett for our wrap up. Thank you.
And as usual, my 5 minutes becomes 1. Karen, thank you so much. Thank you to all your panelists. Thank you to all our speakers. The slides will be sent out post this event. We will also endeavour to answer all the questions that are sitting in our Q&A box here. It's always wonderful to get contributions from people, but if I can ask you, if you appear as an anonymous attendee, it's very difficult for us to get back to you with an answer to your question. So a point to be borne in mind for the next time, please. like everybody else, I was fascinated to try and pick out one quote from the wonderful discussions that we've just had. I was tempted to go for the Flash comment, but sorry, JV, it's not you who's the winner. As Karen anticipated, Ina gets the bottle of champagne. The bottle of champagne is already being delivered to you, Ina, for in real estate, discipline wins. I just hope that doesn't come with a whip, but if you have to crack the whip every now and again, so be it. Ladies and gentlemen, thank you for joining us today. It's been a pleasure to present this. I think it's our 27th webinar. It's been a pleasure for us to put it on. Thank you to everybody for taking part. Thank you for joining us. And thank you back home, as they say, to Izzy for managing all the technical aspects so well. Really appreciated it. See you again for our next one. Thank you so much.